What do Japanese companies, which have been dealing with a weak domestic economy, luxury good companies, which have been hit by cut downs in consumer spending, and troubled automaker Toyota, which has been plagued by recent controversy, have in common? While Morningstar's International Stock Fund Manager of the Decade has found reasons to like them. That's David Herro. He's Chief Investment Officer of International Equities and Portfolio Manager at Harris Associates. He joins us now live from Chicago. David, you've got a lot of really counterinstinctive calls here, and I find them very interesting here. Tell me, why are you finding reasons to put money to work in Japan right now?
Well, one of the secrets, I think, to successful long-term investing is to really look for where the true values are. And where the true values are usually is where the momentum is not. And if you take the Japanese market, it hit a peak in December 31st, 1989. It is steadily falling since then with little fits and recoveries. But today we see good underlying low-priced stocks, but we also see corporate behavior that is ever so slowly changing in terms of making companies more profitable and more shareholder friendly. So, and this we judge by just looking at returns and capital allocation policies.
Now, when Japan is referenced these days, it's typically as sort of a warning for what may come here in the U.S., right? This fear of the so-called lost decade that people worry about with lack of economic growth. But what you're saying, it sounds like to me, is that you're making this call on putting money to work in Japan based on valuations, not necessarily on an economic robustness there.
Yes, what you have to look at is how the macroeconomy of a local economy impacts a company's ability to generate cash flow for its owners. And often, especially if it is a company that has heavy outside of Japan or heavy external sales and profits, it has very little impact. So investors often get confused with what's happening in a macroeconomy with the intrinsic value of the underlying security itself. And this is the imperfection, one of the imperfections we try to exploit as long-term investors.
Now, I'm looking at your Oakmark International Fund, one of the funds here under management, $4 billion there, one-year return, 61%, outperforming 96% of its peers. International stocks, there's so much interest in the emerging markets, but you are actually underweight the BRIC countries, Brazil, China, Russia, India. Why are you underweight the BRICS?
Because our investment criteria is based not on who has the fastest growing economy, but what are the best quality companies selling at the lowest prices. That is our value proposition. And again, like I said earlier, investors sometimes get confused, believing that just because there's fast growth means there is an availability of value, and in fact, often this is just the opposite. That is, the growth gets overly baked in to the share prices, thereby making them unattractive. And in the case of the BRICS, the countries that you mentioned, this is mostly the case.
Well, when I look at the allocation on a geographic basis of your funds, you're more heavily weighted towards Switzerland, Japan, the UK, France, and Germany than those typical international names that are so often bandied about. Tell me, though, looking at what we have seen in the past few weeks with weakness in the euro, would you put money to work in the financial sectors of Europe, into European banks?
It's really on a case-by-case basis. The banks that we have investments in, some of the big Swiss private banks, such as Credit Suisse, UBS, have very large and profitable asset management divisions, which we find very attractive. UBS is more of a turnaround story, but we do believe that the turnaround at UBS is well underway. And though it doesn't look like it in the very short term, over the medium and long term, we're going to see asset inflows back into that private bank. There are some commercial banks we like in Europe as well. BNP, Bank National Paribas, Bank of Ireland is a turnaround story. But we wouldn't necessarily just do a huge basket. It's a stock-by-stock specific story.
All right, David, I know you also like some luxury names, Richemont, Signet Jewelers among them. Thank you so much for this counter call. We appreciate it.